Today, folks, we got to talk about the recessionary environment we're in with this extremely unusual data that's getting released from GDP, the recent tech earnings. And then we're going to be diving down into some of your questions, getting answered. Those burning questions you leave down below, whether it's dividend stocks, US, Canadian stocks, the real estate market, damn it, we're going to be diving into all of it. So always leave those comments down below because one of those could be yours. Now, if this is a conversation you appreciate, hit that like button because the likes of Michael Burry, the likes of Rich Dad Poor Dad's Robert Kiyosaki have been predicting the next Great Depression, damn it. But is that what we're seeing in gross domestic product? Actually, no. It looks like we're heading into somewhat of a soft landing here with higher GDP for the last quarter than analysts were expecting. It doesn't look like anything comparable to 2008 or the March 2020 crash. What that looks like moving forward, I don't know, but that data was good, yet tech earnings gave us a different, more or less bleak outlook in watching these companies graze by from having diversified income, like the likes of Microsoft here, seeing a huge decline in their product sales. So clearly, you know, Microsoft's computers, the Xbox division, perhaps, we're seeing a huge decline in that, going from 20 billion from 2021 to 16 billion for that fourth quarter in 2022. The only thing that kept their total revenue growing was services and other revenue, probably related to cloud, right? So that is rather concerning. We're seeing the same thing with Tesla, right? These companies are the creme de la creme. They're going to get through this environment, come out on the other side better, but we're starting to see them get hit. And Tesla's no exception to this. Even though their demand is absolutely incredible, they're doing the right things, moving in the right direction, we're still seeing their margins fall off a cliff from Q4 of 2021, going from 30% to Q4 of 2022 at 25, 26%, which obviously still higher than all the other auto companies. Tesla's going to be doing just fine, but this is the sign of this slowing environment, this recessionary environment, which again, still could very potentially be a soft landing. But I'll pass the question off to you. What do you guys think Q1, Q2 of 2023 is going to look like? Do you think things are going to get worse? Do you think it's going to get better? You think it's going to be a full-blown depression? I'd love to hear about it. But let's get into some of the questions, the answers, and I want to start with the funniest one from yesterday, where I was talking about the Vanguard Canadian High Dividend Yield ETF, one of my largest holdings, which is a monthly paying Canadian ETF that in the recent dividend declaration, they announced 2 cents, which is the lowest in their entire history, basically to the point where everyone was complaining. I called Vanguard because there was just so many people calling me, messaging me saying, what the hell's going on here? And Vanguard reassured me that they said, hey, there's something going on. You know, the dividend might be a little lower, but it will increase and it'll be that much higher in the coming months because the dividend yield has actually been going up on this ETF. And a lot of you pointed out the fact that they corrected this. The comments were absolutely hilarious because somebody said Vanguard announced a correction for VDY distribution that's now back to 17 cents. I said, laugh my ass off. I'm probably not the only one to ask. So they realized there was an issue. And this is the best comment. Classic Kevin from accounting. Yep. Now they've raised the dividend. It's actually up 24% from this time last year. So the dividend's way higher. And they did release a statement on Seeking Alpha, which was just funny because I feel like because of you guys making those comments, because of me calling Vanguard, I think we actually made an impact on them and they realized they messed up. So I just thought that was super funny. So some other questions from FitBH says, Kyle, any Canadian ETFs one could invest in as a US resident? And to be honest, this is the same thing with me buying US stocks. You can easily buy Canadian and US stocks. You're going to be paying a conversion to some extent. We're lucky in Canada that there's like US counterparted S&P 500 ETFs like VFV. But honestly, I just hold US stocks in their native currency and I got no problem with that. And if you're a US citizen, I'd highly recommend buying things just like the Canadian broad market like VCE, or you can buy VDY. But honestly, you need to pay close attention to the dollar conversion because this is what would have wrecked you if you were a US citizen buying Canadian stocks coming out of like 2011 to 2015-ish time frame. To be honest, this is one of the primary reasons I keep a good chunk of my money in US dollars, because let's say you were a US citizen buying Canadian stocks somewhere around 2012, you would have seen a 25% drop in those Canadian holdings just from the dollar exchange value. So if you sold those US holdings or you were collecting Canadian dividends being a US citizen, when you converted that back, you lose 25% over the last decade, which is abysmal at best. And that's how I've kind of protected my money, because I like the US dollar a little more. It seems to be a little more resilient, a little more stronger, but I have to deal with the same risk. Right now, the US dollar is dropping and the Canadian dollar is rallying. So if I sold my US stocks and converted them to Canadian dollars, I would be seeing a decline in the Canadian dollar value. But but that's why I always just leave my US money in US dollars and my Canadian dollars in Canadian dollars. You can actually operate with both those currencies pretty seamline as a Canadian because the US dollar is the world reserve currency. Now, Mogul Rider asks, half the REITs will be bankrupt by the end of 2024. What are you thinking? They are about to dump tens of thousands of properties on the US and Canadian markets. So this is true. A lot of the REITs like RioCan, Smart Centers, over the next few years, they're going to be doing massive development. And I don't know as much about the US markets, but I think what we're experiencing in Canada is going to be a short-term drop. I don't think it's going to persist because inevitably they're going to lower the interest rates, and we still have a massive supply and demand problem here. And the only thing that stopped that crazy demand was this really high interest rate environment. Everyone's sitting on their hands and they're just waiting to see what happens. But when that demand comes back in the next 3 to 5 years, the Canadian real estate market's going to continue to boom, and it's just going to become another New York, a new San Francisco, Toronto, Vancouver. Those markets are so damn hot, and there's so much restriction on development. We have greenbelt rules protecting land to stop them from developing. I just think that if you have the money and you have the opportunity to start looking for real estate deals, 2023 is going to be the time to do it. Now, when it comes to REITs specifically, you want those resilient ones. Like, this is why I've been looking at things like Slate Grocery REIT, because obviously when they have thousands of properties, they have to unload onto the market with RioCan, Smart Centers. I'm not exactly sure how that's going to look. Now, luckily, RioCan, again, fixated mostly in Toronto. I think they have a cushion because the Toronto real estate market hasn't corrected that bad as of late, but nonetheless, that's some of the risk of holding REITs. That's why you want to find those recession-proof, really resilient ones. I still like Canadian apartment properties. I still like a lot of them. I think if you can catch them on dips and you can ride through this market cycle and you understand the real estate that they own, I think you could do fine, but there is risks, obviously, with real estate in an interest-raising environment. Now, in another real estate question, MH says, good luck finding even one example of a buyer wanting seller's lawyer to hold the money over a brokerage without any restrictions. Plus, everyone has a lawyer on these deals, so getting another lawyer is bad advice. Name one person that buys real estate with a lawyer. Nobody. You go to your broker, you go to the realtor, you set the deal up, you buy one. But hey, when shit falls apart, those aren't your lawyers. There is no lawyer for you. The broker has a lawyer. You know, everyone else has one, but you damn well don't. I learned this the hard way, and my lawyer says, yeah, when things go bad, that's when everyone thinks about getting a lawyer. And when it comes to actually brokering a deal, you don't need RE/MAX. You don't need a mortgage broker. You can do all of this privately and put any clause you want in. You can literally just go up to someone selling real estate and say, hey, I'm going to buy your place. Maybe I'll give you 25, 30% down. I'll give you a 5% interest rate. Forget the bank. If I default on that, you can have the property back. You don't even need to use the bank. You don't even need to use a damn mortgage broker or a friggin' place like RE/MAX. They're not there to help you. And the reason that I get so heated about this is because I've been dealing with this personally. And when you get a deposit, you don't own that deposit. Nobody does really until the deal closes. And when the deal doesn't close, guess what? The broker holds that money. You don't get anything to deal with that money. Even though it's your money, you have to go fight them in court if they don't sign the release. And guess what? When they sign the mutual release to get that deposit because they didn't close on the deal, they flaked out, guess what? You can't sue them anymore because that release states that you're relieving them of liability. So it's like, if you want to sue them, guess what? You don't get access to the deposit. You have to fight them for the deposit and the loss of the property value. I'm getting really heated here. I'm going to put this aside. I think what you're saying here is completely wrong. And if you do have a lawyer, good for you. You're already 10 steps ahead of most people that deal with real estate. But putting that aside, Mr. Financial says, hey, Kyle, for a fair comparison of your portfolio, you'd have to start that chart from when you started investing heavily in 2020 or at least mid-2017. Short-term results in a massive rally not seen in decades may be luck for sure. To do it in a downturn or a flat market, a bear market over decades, that's the difference between Warren Buffett and other greats and someone that did well by luck. Now, this comment is particularly in relation to the performance of my portfolio, which has been stellar over 7 years, outperforming Berkshire Hathaway's, Jeremy from Financial Education, all these YouTubers, and most of that has got to be luck. I am not denying that because I sold out of my tech stocks at a wonderful time. I sold out of Tesla at a wonderful time, but the positioning at what I did with that money, I think wasn't luck, like me buying SCHD, buying resilient dividend ETFs coming into this recessionary environment. I think I poised myself to perform well, which is what I don't think most YouTubers did. So there's a good variation of education, luck, all of it coming together and giving me this kind of outperformance during these really horrible markets and not experiencing the 50 to 80% correction a lot of these YouTubers were experiencing in their stocks. But at this point, I'll pass that question off to you. I'd love to know what you guys think about this recessionary environment. You think we're heading into a soft landing, the next Great Depression, and anything about dividend stocks, REITs, or US companies, let me know.